All right, welcome back to Talk Tickers. Today we are diving deep into TechnipFMC, ticker FTI, Q3 2025 earnings. And you definitely saw the market reaction. Stock jumped pretty significantly. So our mission today, figure out why. Let's break down the results, get into the tech that's driving things, and understand that big capital return news.
Yeah, this was a really strong quarter for FTI, more than just hitting the numbers, I think. They really demonstrated the power of their specific model. The market reaction wasn't just about a beat. It felt like it was rewarding, operational control and this huge commitment to shareholder returns.
Okay, let's start with the headline numbers then. The profit beat was pretty stark. Adjusted EPS, 0.75. That flew past the consensus, which was around 65, 66 cents?
Exactly, a really strong beat there. And it's built on solid ground, too. Revenue came in at $2.647 billion. That's up, nearly 13% year over year. But the real story, I think, is the cash. CFO, $525 million.
Which turned into massive free cash flow, right? $448 million.
$448 million free cash flow.
Yeah.
That kind of cash generation consistently is what lets them make these big moves.
And it looks sustainable, judging by the orders. Inbound orders were $2.65 billion for the quarter, kept the book-to-bill over 1. And Subsea, the main engine, pulled in $2.4 billion of that.
Right, which leaves the total backlog still really solid at $16.8 billion. That gives them, incredible visibility looking out a few years.
Okay, and that visibility, that confidence led to the, let's call them capital fireworks. This seems key to the stock move. The board added another $2 billion to this share buyback authorization.
An additional $2 billion, that's huge. Brings the total available to around $2.3 billion. And they didn't just authorize it, they acted on it. Bought back $250 million worth of shares just in Q3. That's a serious commitment.
It is a serious commitment. And, maybe this is just me being a bit skeptical, but when you see a buyback that big, especially in this kind of industry, does it make you wonder if they're maybe running out of high return places to put that capital internally? Like, are they just returning cash because they can't deploy it effectively?
That's always the question, isn't it? But management seemed to tackle that head on. They tied the capital return directly to the efficiencies they're getting from their technology.
Yeah.
They're pushing this more with less strategy, which inherently makes them less capital intensive than some peers.
Okay. So the message is the advantage comes from the tech platform, not just throwing CapEx at problems.
Exactly. It's engineered, not just bought.
Yeah.
Which maybe we should pivot to that tech story now. But first, just that management conviction.
Right. Okay, deep dive time, execution and technology. Management sounded really confident about hitting over $10 billion in subsea orders for the full year 2025.
Yeah, they doubled down on that.
Yeah.
Which keeps them on track for that bigger multi-year target, $30 billion in subsea orders over 3 years.
And getting there isn't just about, winning bids, it's about being different.
Precisely. It comes down to really 2 core innovations they kept highlighting. First is Subsea 2.0 RA. You can think of it as like industrializing deep water gear. It's pre-engineered, more configured to order, cuts down cycle times, engineering effort compared to the old way of doing things.
And the second piece, the execution model.
Yeah.
iEPCI, integrated EPCI.
Right. Integrated engineering, procurement, construction, installation. They stressed it's the only fully integrated model out there. So instead of the client juggling like 4 different contracts, 4 companies, FTI takes it all on. Single point of contact, single responsibility.
And the impact of that integration
is pretty profound. Competitively speaking, it means better schedule certainty for the client, better project economics overall. It basically de-risks things for them. And the result, management said 0% of their business is now direct awarded.
Okay, let's pause there. 80% direct award. For someone maybe not steeped in the deep water world, why is that such a big deal compared to winning competitive tenders?
Well, it's a fundamental shift. Traditionally, projects go out for tender, everyone bids, often competes heavily on price, right, which eats into margins. A direct award means the customer, say Exxon or Petrobras, has decided FTI's specific integrated offering that Subsea 2.0 plus iEPCI combo provides unique value that, maybe they feel they can't get from competitors relying on the old fragmented approach. It means schedule certainty and integration are winning out over just price. They've essentially walled off 80% of their work from direct price competition.
And you can see that playing out in the actual contracts they announced.
Yeah.
South America seems particularly strong. They mentioned the Hammerhead project for Exxon in Guyana.
Yeah.
That's their 7th SPS award there, which is pretty amazing.
Yeah, 7th since 2017. And big wins with Petrobras, too, for flexible pipe and SPS. It's not just luck, it's that model gaining traction.
And that feeds right into the margin story, which feels like the really crucial part for investors thinking longer term.
Absolutely. Because they're standardizing, industrializing with Subsea 2.0, they get real leverage. Those Subsea 2.0 orders are now over half of their inbound, and they think by the end of 2025, something like 40% of their facility capacity will be running Subsea 2.0 work.
So financially, what's the implication? Faster margin growth.
That's the expectation.
Right.
Margin growth accelerating faster than revenue growth. Because of these internal efficiencies, it's not just tweaking things, it's a fundamental industrialization process.
Okay, and that confidence flows straight into the guidance they gave. For the full year 2025, they bumped up the free cash flow guidance pretty significantly, now $1.3 to $1.45 billion.
Yeah, up from, what, $1.0 to $1.15 billion before. That's a substantial raise. And they also nudged up the margin target for surface technologies to 16.5% adjusted EBITDA.
But the real jaw dropper, I thought, was the early guidance for Subsea in 2026. That's pretty rare.
Very rare. And very strong. They're projecting Subsea revenue for 26 between $9.1 and $9.5 billion. And this is the number to watch, just the EBITDA margin between 20.5% and 22%.
20% plus EBITDA margin. In the sector, that's a different league almost.
It really is. If you look at the midpoint of that 26 guide, it implies like double-digit EBITDA growth in Subsea.
Okay.
And crucially, that EBITDA growth is basically double the expected revenue growth rate. That's the proof point for the whole thesis, right?
Yeah.
The tech stack is generating expanding returns. Huge leverage.
It is super aggressive guidance, though. I mean, what happens if execution slips? Or if that Subsea 2.0 adoption maybe slows down a bit? Is that 20% plus target really locked in?
Well, execution risk is always there, right? Managing supply chains at scale. But their advantage is that massive backlog. A lot of these projects are already secured, customers committed. The bigger risks are probably external, major commodity price swings hitting future project decisions or geopolitics. But related to guidance, they were a bit more cautious on the surface segment, deferred full 2026 guidance there, said it's just less predictable than Subsea.
Though current surface performance is strong, they said, helped by investments in places like the Middle East.
Exactly. Actions they've taken there, especially local manufacturing, seem to be paying off.
Okay, so strong cash flow, confidence in future margins, brings us back to capital allocation. They're sticking to returning at least 70% of free cash flow to shareholders in 2026, just like 2025.
Yeah, reaffirming that commitment. And they're doing it while also cleaning up the balance sheet. They cut gross debt by over $450 million since the year started, even paid off some 2026 notes early, opportunistically. So the net cash position is up to $439 million now. Deleveraging while funding the buyback. Strong financial management.
And the bigger picture, the macro environment seems favorable too. More investment heading offshore.
It does seem that way. Project economics offshore are looking better, partly thanks to the schedule certainty FTI's model offers. And, generally higher quality reservoirs offshore compared to some onshore plays. The industry seems to be valuing the efficiency FTI brings.
Okay, before we get to the trade idea section, quick update on electric subsea. That always sounds futuristic.
Yeah, it's interesting. They mentioned greenfield adoption, totally new, big all-electric projects is maybe a bit slower than they first hoped, but new applications are popping up.
Like carbon capture, CCS.
Exactly. They said CCS projects are going all electric, using their CO2 injection tree, which is already certified, and also brownfield tiebacks connecting existing infrastructure. Electric tech apparently lets them extend the reach, like 4 times further out from the host platform, unlocks reserves that were too far before.
Wow, 4 times. That's significant.
It is. And one other really neat thing, they can now apparently retrofit existing hydraulic trees with electric parts while they're still on the seabed, using ROVs.
So you don't have to pull the whole thing up.
Right. Avoids massive cost and downtime. Shows real R&D cleverness, that adaptability.
Okay. It's time for our segment. This is not financial advice. Remember, this is purely for analytical, maybe entertainment purposes. An outrageous but plausible trade idea based on what we heard.
Right. So the core idea here is that the market, even after this jump, might still be underappreciating the combined power of that higher FCF guidance and the massive buyback authorization. FTI seems to be achieving a kind of technological leverage that, maybe some competitors stuck in the old asset-heavy, bid-heavy model just can't replicate.
So the outrageous but plausible trade.
It's a relative value play, essentially. Long FTI, betting on that margin expansion story, really accelerating, and maybe pair it with a short position in a competitor you think is more tied to those traditional capital-intensive, lower-margin models.
So you're betting FTI's TechMix, Subsea 2.0, iEPCI, and their capital-light approach causes their valuation multiple to expand faster than the sector average.
Exactly. Over the next, say, 18 months. If they hit that 20% plus Subsea EBITDA margin in 2026, we think their EV to EBITDA multiple deserves maybe a persistent 15-20% premium compared to peers. A premium that isn't fully priced in yet, we'd argue. It's betting on that leverage and industrialization story that seems unique to them right now.
Okay, so wrapping up. A clear beat and raise quarter, driven by what feels like genuine technological differentiation, strong cash flow.
And that huge commitment to capital returns.
Right. And the final thought to leave you with?
It's something management hinted at. That list of proprietary direct award opportunities they're working on, the ones that never even go out to public tender, is apparently growing even faster than the public project list.
Which suggests that competitive advantage, that wedge.
It isn't just stable, it might actually be widening. Something to think about.
Definitely something to think about. Okay, that's our deep dive on FTI's Q3. As always, this is not financial advice. Please do your own research. Use this as a starting point for your own analysis. Thanks for tuning in to Talk Tickers.